This video is recorded for the Tennessee Master Road Provider. I'm Aaron Smith, a professor and extension economist in the Department of Agriculture and Resource Economics. And this video is going to discuss credit renewals and applications. There's a few things that we're going to step through before we get into kind of how ag credit providers look at row crop applications for credit renewals and extending additional credit. So we want to talk a little bit about what's going on with interest rates and inflation, what's happening in the ag economy, and then kind of do a little rewind on Tennessee in terms of where we were in 2024 and into 2025. Talk a little bit about government payments, and then close with talking about preparing loan renewals and credit applications for 2025. So the first thing that we need to look at is where we've come from inflation. And this obviously has two different components that are embedded into it. One, it's increased our production costs in agriculture substantially compared to where we were 5 years ago. We've seen everything from fuel, fertilizer, energy, equipment come up in prices. And a lot of that was driven by inflation coming out of the COVID-19 pandemic. And you can see where we peaked back in 2022 and 2023, where we were well over 6% on an annualized basis for inflation. It's come down substantially, where right now we're between 2 and 4%, which is still elevated relative to where we were before 2021. But again, it's something where it's come down substantially, and it has been pretty consistent around 3%. One of the things that the Federal Reserve used to combat inflation was increasing interest rates. And so this graph ends up showing the bank prime lending rate as indicated by the St. Louis Federal Reserve. You can see we peaked up at about 8.5%, and we've seen that come down to 7.5%. A lot of where interest rates are going to end up going is going to be dependent on what happens with inflation and the general economy. When we think about what the impacts of elevated interest rates are, there's a few that are a little bit more obvious for everybody that borrows money, and there's a few that affects our decision-making process that we need to be aware of. And then there's obviously some impacts when we look at supply chain. Anytime you're looking at carrying inventories over multiple months, that the higher interest rate is going to increase the cost of carrying that inventory. But first, we want to look at what that means in terms of just the access to capital. So in this simple example, what we have is a $500,000 loan over 15 years at three different interest rates, 3.5%, 5.5%, and 8.5%. And then how much is paid in interest over those 15 years, and then compared to that 3.5% baseline. So when you look at a 3.5% interest rate over 15 years on $500,000, you'd pay approximately $143,000 in interest. When we bump that up to 8.5%, you're paying $386,000 in interest, or a difference of $242,000. A substantial increase in the amount of interest paid over a term loan. This also applies to operating loans, right? So in this example, we have $1 million worth of operating utilization, and I'm assuming a 2,000 acre farm, where we're looking at interest at 3.5% of $35,000 or $1,750 an acre, compared to 8.5% at $85,000 or $4,250 an acre. So it changes both our term debt and our operating debt in terms of what the cost is and how we budget for that over time. The other ones that it affects are our input purchases and our crops held in storage. And so when we think about this in terms of input purchase timing, a lot of times we purchase inputs at the end of the calendar year for tax purposes and for planning purposes for the upcoming crop year. Well, when we're carrying that inventory, that money's went out the door if we paid for fertilizer, for example, and there's an interest cost available, or that should be calculated as we carry that month over month, because that cost has been incurred. We haven't utilized that input. And so again, when we go back to higher input prices plus higher interest, you're getting a double hit in terms of the value of the input cost, but also the cost to carry it over time. So that's just going to increase our interest expense when we do our budgeting and farm planning when we're carrying more inventory. And even if we're not borrowing, it's important to end up realizing that if we do have that cash on hand, we are foregoing some other opportunity. And so just the simple example is if you have a certificate of deposit rate somewhere between 4 and 4.5%, that is something that is potentially foregone if we're utilizing that to carry inventory or to end up making pre-purchases. And so one of the questions that I always get, usually at the start of harvest, is which commodity, corn and soybeans in this case, is paying to end up carrying over time. And there's two different components that we really want to look at. We want to look at what's being offered in the futures market. So looking at our futures prices for the current contract or the nearby contract and all the deferred contracts. That's going to give you a price spread. We should always adjust for basis. In this example, I've not included the basis numbers in there, but we should put in our projected basis to get what that price spread is. And then we need to account for that interest cost. And so if we look at an operating loan interest rate of 8.5%, the monthly interest cost per bushel to carry a bushel of corn is about 3 cents, and to carry a bushel of soybeans about 7 cents per bushel. And so again, this is just the interest cost. This is not factoring in any of the other costs of storage, such as capital recovery on bins, additional handling, additional movement and shrinkage that could end up occurring. What we want to look at is what's the difference between the price spread, the interest expense, and then that'll tell us which commodity relatively is going to be more profitable in terms of storage. And so again, as mentioned, we want to make sure that we have both the futures and our local projected basis accounted for in that calculation. When we look at farm income and commodity prices, this is a chart that was put out by the Kansas City Federal Reserve, and it really shows kind of two different economies within the agricultural sector. When we look at crop prices, which is the green line, we can see that we are down substantially from where we were in 2022 and 2023. And I'll talk a little bit about the Tennessee numbers in a little bit. And then we have cattle prices in blue, where we've actually are near record high cattle prices. So again, depending on what sector of the ag economy, the price outlook is very different between livestock and crops right now. When we look at where some of the USDA data is, when we look at corn and soybeans, this shows cash receipts for select crops for 2023, 24, and 2025. You can see pretty much across the primary row crop commodities, we are projected down substantially from 2023 and even down for most of them compared to 2024 when we look at 2025. So again, it is going to affect our ability to access credit because we're coming off of a down year in 2024, and we still have projected lower cash receipts on the crop side. But when we look at the cattle side of things, that's a little bit different, along with some of the other livestock and poultry industries. There's a very different outlook when we look at what the cash receipts are. When we look at production expenses, again, we have on the left-hand side inflation adjusted production expenses. And you can see we're maybe down a little bit from the peak in terms of our input costs and production expenses, but we're still at a very elevated level to where we have been in the past. And when we look at these different select farm production expenses, you can see the categories with a nominal increase versus a nominal decrease. When we're looking at increase, we're looking at labor, livestock and poultry purchases, seed purchases, property taxes, and cash rents. When we're looking at ones that have maybe come down a little bit, feed purchases, interest has pulled back just marginally compared to last year, even though it is still up from 2023. Fertilizers come down a little bit, pesticides and fuel and oil have also come down a little bit. But again, we're still in an elevated input cost environment. When we look at direct government payments, again, we can see the impact of the COVID-19 pandemic in 20 and 21, where we got a large amount of payments. And then after that, we've seen payments really come down. There are some payments that are announced for 2025 that we'll talk a little bit about to mitigate some of the price declines that we've seen. And then we still have our traditional farm safety net, which does need to be updated, particularly some of the reference prices when we look at programs like ARC and PLC that were set many years ago when we were under a different cost structure. The 2018 Farm Bill is still in effect through continued renewals all the way out until September 2025. So when we look at Tennessee, I just ran some quick numbers for the state in terms of what Tennessee cash receipts look like in 2023 versus 2024. And so when we look at this, We're looking at state averages here. Most of this data comes from USDA NASS. When we look at yield was down for corn 12% 2020 in 2024 compared to 2023. Price was down another 6%. And when we look at gross revenue per acre, that results in about an 18% decline. Harvested acres were down, so our cash receipts on the corn side was down almost 40%. And this has a bunch of different ramifications when we look at this. Obviously, at a direct farm level, it makes it so that we have much less cash to end up paying our bills, covering our expenses, and to plan out through the future. That also reverberates into input suppliers who are going to be paid off for the inputs that were purchased over the course of a production and marketing year. And then any agricultural loans that are out there, this is going to adversely affect how much we're able to end up paying. When we look at some of the other commodities, again, this is pretty consistent in terms of the direction where we have the lower yields. Soybeans substantially lower, 18% lower than 2023, price down almost 20%. When we look at that, Tennessee cash receipts, 24% lower year over year. When we look at cotton, very similar in terms of the numbers, where lower yields, lower prices, lower harvested acres, and obviously that affects our Tennessee cash receipts, lower by about 29%. And then finally, we have wheat, which again follows that same distinctive pattern. So when we think about this in terms of summary, prices are down substantially from 2023 to the 2024 crop, and that follows the national trend. Obviously, prices are set by and large outside of the state of Tennessee, and so the prices have followed the national trend lower, although we did have some very beneficial basis offerings this fall and into early spring here. Tennessee yields are down 6 to 18% compared to last year. That is not the same as a lot of national trends. It really depends on what state you're in as to whether you had higher or lower yield, but we did set a national record yield. So again, we're not following that trend. And so we think of it in terms of gross receipts. There are places where even though we had a decline in prices, some of the yield increases potentially offset some of that in terms of a gross revenue standpoint. In Tennessee, that was not the case. We had both the price hit and we had a yield hit. And so when we put that together, just for our 4 primary row crops, our cash receipts are projected to be down about 31% or not quite $700 million compared to last year. So that's a huge hit to row crop producers and to the agriculture communities across the state. And so when we think about this, there's the immediate impact, and then there's, while we're planning for 2025, having a down year in the low price environment is going to make it more challenging for a lot of farms to obtain the credit that they need to end up planting, harvesting, and marketing their crop. So there was some payments that were announced to help mitigate some of these losses, and this is a national program under the American Relief Act, and this hasn't necessarily been finalized. We're still waiting for some more details to come out. But again, I think that the payments are pretty close to where they will end up being, and these are based on per planted acre that is reported to FSA. And so if you planted corn in 2024, you'll get roughly $42 an acre, for soybeans and wheat, roughly 30, and for cotton for 87. And so when we look at this, these payments should be coming out by the end of March, although with some of the challenges in Washington right now, that might be revised. I know working with some of the FSA offices, they haven't received the details. We're already in early March here, so it could be challenging to hit that deadline, but we'll have to wait and see. But these payments have been authorized and should be coming out to assist with the lower price environment. If you did have prevented planting acres on your farms, you will get 50% of this payment amount on those prevented planted acres. And again, this is on 2024 planted acres that were reported to FSA for these payments. Now, when we think about it in terms of mitigating some of the losses that we've seen in Tennessee, it's going to vary tremendously by county. I'm going to use Dyer County as an example, but we can calculate these for all 95 counties in Tennessee to get an indication of what some of the support payments are looking like as we go through our budgeting for 2025 and where we might see cash coming in. And so when we look at Dyer County, I'm going to talk about Arkin PLC. These are our Title I commodity programs. And this chart just ends up showing how many base acres, because when we're talking Arkin PLC, we're not talking payments per planted acre, we're talking payments per base acre. And so what we can end up seeing here is that for our corn base acres, we had 34,000 acres enrolled in ARC, very little enrolled in PLC. And you can go by commodity to see where the 2024 enrollment numbers came in. And again, these are ones where we went into the FSA office and signed up in spring of 2023 to end up or spring of 2024, sorry, to end up getting these payments. And these payments won't be issued until October of 2025. So when we look at some of these estimates, I pulled just some standard numbers when we end up looking at the number of enrolled base acres in the current year, what that 2024 ARC guaranteed revenue was, what the projected marketing year average price and what the county yield projection was. Both this marketing year average price, because we're not done the marketing year, may change, and these estimates for county yield have not been formally released. So these are estimates based on conversations we've had with county agents and producers. And so again, there is some uncertainty that's embedded in here. There is a maximum because our county only covers the shallow losses. And then we do have our effective PLC reference prices. And so when we look at this for Dyer County, we'll see that there's a PLC payment per base acre. Right now it's estimated at 45.41. When we look at ARC County payments per base acre, again, these are subject to change, but we can see that there is a good chance that we will receive payments under the ARC County payment or ARC County program because of the lower yield environment we're in there. So again, these are estimates and they will change based on how county yields and the marketing year average price change from now until the end of August. These payments will be made after October 1st, 2025. And so again, it is a little challenging when we think of this in terms of planning because these are associated with the 2024 crop, but the payments will actually be made when we're harvesting the 2025 crop. So it's a little bit challenging when we look at where should we attach these payments. And so there's two other things that I think are important to consider. One, in Tennessee, our base acres do not necessarily match what we plant. And so when we're looking at this, it may be worthwhile if you have a lot of farms that your base acres and your planted acres don't match up to kind of look at a weighted average payment per planted acreage or acre and assign that rather than going commodity by commodity, because we will have sets of circumstances where we have a corn base and we're planting soybeans, or we have a cotton base and we're planting soybeans, where you're going to get a cotton payment, but the crop that was planted on those acres was soybeans. And so how do we deal with that? The way that I would suggest, if you have a huge difference between the number of base acres and the planted acres that you end up having, is for each individual farm, take the number of base acres, multiply by the estimated payments, you get a total payment, and then divide by the planted acres. You can get a planted acre payment that is based on the weighted average on that. And so again, I think that's something that can assist when we're looking at it from a potential cash payment standpoint. The other key portion of the farm safety net for row crop producers is obviously crop insurance. This just gives a quick summary, and this is specific to Dyer County, but we can pull these for any county in Tennessee. But you can see where the buy-up coverage is for revenue protection crop insurance. Typically, we'll see a clustering between that 70-75% with some commodities even bumping up to 80%. When we look at other components of the crop insurance safety net, we have total acres insured by commodity, any companion policy acres, so ECO, SCO, MP, and stacks that were purchased for the 2024 year. This average coverage level does include RP and YP, so it is lower than that previous table that we showed for revenue protection insurance. And then this is the liability amount. So this is the amount or the value of the crop that was insured in 2024. This is the total premiums that went into the pool. This is the producer portion for Dyer County, and this is how much was paid out. And so again, when we look at this, there was a substantial amount that was paid out in 2024. It varies tremendously by county, but crop insurance did have some pretty good sized payments because of the lower yields that we had in the state of Tennessee because of drought. And so again, I encourage you to look in terms of what the benefits were from crop insurance. Use that to guide your decisions as you move into 2025. So we're looking at preparing loan renewals and evaluating credit needs. We really need to get out in front of this in a timely manner. It's really important to continually evaluate where you are and the access to credit that you will need to end up conducting operations. One thing that I think is really important is to assess what your credit needs are. Not just renew exactly what you did the same year, but look and see where you are in terms of operating loan limits, in terms of long-term or term credit needs, and kind of go from there. So when we're entering this credit renewal period or looking to obtain new credit, I think there's a few things that we should consider. The first one, surround yourself with the right people. I'll talk a little bit about kind of a key kind of personnel list for crop producers. But commercial agriculture is very complex. It's very difficult to stay on top of all aspects of a farm in terms of financial. So we want to make sure that we have good people in our support network that can guide our decision making and help us gather the information so that we can make informed decisions. Want to determine how much credit do you need for 2025. I think one of the big things that we want to end up thinking about is when we obtain credit, we want to look at not just the production season, we want to look at that marketing season. I'll just give a simple example on this. If we do end up financing a lot of our inputs through an input supplier, and there can be some great advantages, lower interest costs of doing that. But if that input supplier wants to be paid off by December 31st, and your plan is to store until March 31st because you want to take advantage of seasonal price improvements, whether it's basis or futures, um, you do need to end up having something in place to end up bridging that need, right? So it's not just the production season that we need to consider credit. We need to end up considering all the way until we end up that or finalize the end of that marketing season as well. So it's really important to think about the timing, not just the sheer dollar amount that we end up having. Obviously, record keeping data analysis is incredibly important. It's something where what we want to do is we want to make sure that we're gathering data so we can make an informed decision that can help end up getting credit for the 2025 or future production seasons. When we look at our current financial position and formulating expectations, we all wish we had higher prices. Unfortunately, that does not appear to be at this point in time the price environment that we're entering into. But what we want to know is where we're at, where we might be going in 2025, and making sure that we have the agricultural credit that is needed to end up continuing down that road. What do lenders consider? We'll talk a little bit about 5 things that most lenders are going to end up looking at. And then I'm going to talk a little bit about loan structure and working with lenders as we go through the credit season. So the first one is who's in your support network. I've shown this at a lot of different meetings over time, but I do think it's really important to make sure that you have a good, strong support network. Lawyer, accountant, or crop insurance agent specific to this talk, an agricultural lender. And this isn't to say that you're just going to get loans just from one source, but if you have a trusted lender, they will have no problem telling you, hey, you know what, we can't meet that offer, but here's something that is in your best interest, whether it's a rate, whether it's the type of credit that you're looking for. Having somebody where you have a good relationship where you can talk back and forth, I think is absolutely essential when we look at that. Having somebody on the finance side of things when we look at obtaining credit, I think is just so important to have somebody that you can end up talking to. When we move on to marketing, some people will market their own crops. I think, it may be not a strong point for every producer out there, but having a broker or somebody that can help guide marketing decisions is important. And then obviously we need to end up having that support network around production where we have consultants, agronomists, vets, if you have livestock. And then we have a great network of extension agents and specialists that can really assist with planning or getting the correct answers for any problems that you may have through a production or marketing year. When we look at how much credit do I need, obviously we want to break that into kind of 2 different components, the operating and then the capital side of things. So we're looking at operating expenses. What we want to do is develop a budget and a cash flow, look and see where we're going to have cash flow shortages, kind of look at where the bottom of that cycle might be. Obviously, when we're going through the entire crop production and marketing year, it's going to depend on how you market that crop. Do you make most of your sales near harvest where you're not carrying that into the new year, or do you end up spreading out your sales and do most of that kind of January into the spring of the following year. That's really going to change what type of credit and how you need to end up accessing that. Evaluate your cash resources. Everybody's going to have different cash resources. How much you want to designate of your own cash resources is going to be operational specific. And then when do you make those input purchases and sales timing? I mentioned when you're selling, but that applies to when you're buying your fertilizer as well. A lot of people are going to do some extensive input purchasing when we're looking at that tax or that pre-calendar year end time period just to end up offsetting some taxes. So again, that might be something where you need to make sure that you have the credit lined up long before that occurs and make sure that those operating loan limits have enough of a buffer to end up covering unforeseen increases in expenses. I will talk a little bit about loan structure at the end where we're talking about why it's imperative that we don't look at putting capital items on an operating line of credit, but we do want to make sure that we have a sufficient buffer there so we're not scrambling in the middle of a busy production season to try to end up getting more credit. When we're looking at capital purchases, one of the things that I'm a huge proponent of, I'm a spreadsheet guy, so I put a list of all the key pieces of equipment and machinery in a spreadsheet. And what we want to look at is the value, the age, the remaining useful life, the salvage value, any outstanding loan or payments, any tax liability or depreciation, the replacement cost, and a projected replacement date. And the key here isn't to write anything in stone. What it is to look and evaluate our machinery needs and maybe when we need to end up replacing key pieces of equipment. So what we want to avoid is having to replace, 5 or 6 pieces of key equipment when we maybe don't have the cash flow or prices at a high point in time, right? And so again, what we want to use that is just to guide kind of our planning and capital purchase decisions. And then obviously land purchase or operation expansion. If you are looking to grow the operation, we want to make sure that we have the credit set up so that if a piece of property does come up for sale, that we have the ability to potentially act on that as quickly as possible, because we all know land is still very, very competitive in Tennessee. And so again, it's something where we want to make sure that we've got as many benefits to obtaining that or advantages to end up attaining that property as possible. So I mentioned the importance of records. I know most people, this isn't why most people get into farming, but it's incredibly important to make sure that we keep production and financial records. And the key to that is not just to collect the data, we have to be able to organize it and analyze it so that we can make decisions, right? And so when we're thinking about it in terms of going into the bank, we need to be able to generate key financial statements. So when we look at that, balance sheet, income statement, cash flow, and budgets are really important documents that we can use to help secure agricultural credit. And we want to be able to look at our ratios. And I'll talk about some of the key ratios that banks will end up looking at. When we look at making decisions, what these key documents can end up doing is allowing us to make decisions on operating credit requirements when we look at budgets and cash flows, what our loan structure is when we look at balance sheet, and then capital purchases when we look at balance sheet and income statement. So another key component is to look at where your current financial position and formulate expectations. When we do our year-end balance sheet and income statement, that'll give us a snapshot of where we were in 2024. Most people, that's going to be December 31st, but it might vary depending on your corporate structure, when your year end is. Another major benefit to end up going through this time of year is to end up looking at list of outstanding loans. Look at the payment amounts, the payment timing, the interest rate, amortization, and term. We have seen interest rates come down a little bit, so there could be some opportunities if we had some term debt that we occurred over the last 2 years. There may be the potential to drop that interest rate down a little bit. We need to make sure that we stay on top of that because there's no guarantee that interest rates are going to continue to go down. So if there is a 25 basis points or 50 basis points on the table, take that, lower the interest rates, and then if interest rates continue to trend down, we'll take that as we move. Because what we don't want to end up doing is have 25 basis points on the table and have interest rates go back up to end up combating inflation or some other cause that's outside of our control. When we look at cash flow projections or budgets for the upcoming year, we really want to have estimates of what that cost of production looks like, what's a reasonable price expectation, and then what does our trend line yields end up looking at, or what is our yield expectation. We can do that by commodity, or we can do that by commodity and individual field. So here I have the budget that we put out. For those of you that are interested, you can access the UT budgets online. Obviously, it's going to vary tremendously across the state. We have people that target very different yields. We use the state average of about 175 bushels per acre in here. And so again, you do have to adjust these different categories. But when we look at this, there's kind of two things that we really want to end up getting to. What is our return above these specified costs? And then another one that we want to consider is what is our cash cost per bushel versus our non-cash cost per bushel, or our economic cost per bushel. And the easiest way to kind of give an example of this is cash cost. I think everybody understands reasonably well. That's the money that goes out the door. It's the checks, it's the cash, it's the credit card, that we have to end up making those payments throughout the entire production and marketing year. The non-cash cost includes those cash costs, but also capital recovery over time. And the easiest example that we can provide of that is if you have a combine and say it's even paid off, there's no loan on it or anything, there is still an economic cost to utilizing that. You do not use a combine in one production cycle, but at the end of 5 or 10 production cycles, you sure want to have the capital available to end up buying a new one, because we know there's a defined useful life for that piece of equipment. The other thing that we want to do is we want to look at sensitivity to changes in cost categories. So fertilizer is a big one. There's a high degree of uncertainty in some of our cost structure right now due to the potential for tariffs and retaliatory tariffs, where there's a huge degree of uncertainty. And then we want to end up looking at where is that break even and where do we want to set our marketing year price points. So I mentioned we want to look at the sensitivity to cost. We also want to look at the sensitivity to yield and price when we're planning for the upcoming year, because when we start a production season, we have yield uncertainty and we have price uncertainty. And so what we want to do is we want to take a look at kind of what are some likely outcomes for my yield target. So I'll use 180 bushels as a yield target and $5 as a price target. That would result in $83 profit when we look at an $817 cost of production. And so when we look at that, what we want to know is, okay, if we had 170 and price fell to 425, how much of a loss would it be? Or if we got more yield and a higher price, where would we be? What this allows us to do is to end up looking at this, not just at one point in time, but as we move through the entire production year, so that we can periodically look and say, well, my cost of production went up a little bit or it went down. Maybe we didn't have to do that extra spray. My yield is going up because we've got some timely rains. Prices went down a little bit. Just reevaluate where we are in terms of the financial position within a production year. So when we look at key factors for lenders, and I know this is something where it can be challenging to generate these, but when we think of the 5 things that lenders will look at in some capacity are repayment, liquidity, solvency, collateral, and the relationship with the borrower. So when we look at repayment capacity, I'm just going to use some very simple examples when we end up looking at this. So if we had gross cash income of $44.5 million, cash expenses of 4.75, we had net cash income of minus $250,000. Our total debt repayment was $350,000. So we had a negative debt coverage ratio. And you can see these are just some general guidelines. They will vary slightly depending on institution, and definitely vary depending on what sector or what commodities you end up producing. But again, this isn't an uncommon set of circumstances in Tennessee because of the drought and because of lower prices, where we've seen a net cash loss for 2024. And so when we look at this, if we have repayment issues, there's a couple of different things that we can end up looking at doing. We can look at restructuring that debt. We can look at adjustments to commodities and production practices. I think we need to be really careful with those two. I think there's a reason why we grow what we do. But when we look at this, I think it's something where when we're looking at putting debt together or restructuring debt, that can be a real viable solution in the short term to assist with repayment capacity issues. The next measure is liquidity. And here what we're looking at is we're looking at current assets and current liabilities. And so if you take your current assets of $2.3 million in this example and $1.275 million in current liabilities, that gives you a working capital of $1,025,000, or a current ratio of 1.8. And again, we have a scale here from weak to excellent. And so in this case, we're right in that acceptable range. The other one that I will point out is when we're looking at liquidity, one measure that I really like to end up looking at is the liquidity burn rate. Essentially, all we're doing here is we're taking this working capital number and we're comparing it or dividing it by this loss. And what this ends up telling you is if you're losing $250,000 a year, you will be illiquid or won't have any liquidity left in 3.1 years, right? And the reason why we look at liquidity, it's often an early warning of financial challenges. This one can be easier to address than solvency or repayment capacities and capacity. And so when we look at this, some solutions for liquidity issues. One, we can, depending on the farm structure, the farm entity structure, we can rely on shareholder injections or family member cash injections. We can do an equity draw. So we can end up taking some equity from property, for example, and using that to end up reinforcing our current assets. We can end up having equipment and asset sales that could potentially drop our liabilities, our current liabilities, and then we can also look at a debt refinancing as well. When we look at solvency, in this example, I think we've got a total asset base of 13.5 million, total liabilities of 3.5 million, so a net worth of $10 million. You can also calculate an equity burn rate, where again, if you're losing $250,000 a year, you have 39 years before you've eaten all your net worth up. When we look at this, one of the benefits that we've seen to these increased land values, if you've owned land for several years, you likely have a pretty substantial amount of equity built up in your property. So you can end up utilizing that to end up helping with liquidity or debt restructure if we're looking at doing a debt consolidation. When we look at solvency solutions, again, these can be more challenging to deal with, but we can look at land or asset sales to pay down debts. And then again, looking at shareholder or family member cash injections. The other category that most lenders will look at is collateral, and typically they'll break it down into land collateral versus non-land collateral, right? And so it's a completely different risk profile. If you have a piece of property or piece of land with a reasonably low loan to value versus if you're looking at inventory or machinery risk. So again, that will end up factoring into the credit decision. And when we think about this, one of the things that I always encourage producers to do is to know, one, what the value or what their ratios are doing in terms of how strong of a borrower they are, what the collateral is telling you, and negotiating accordingly. So if you have a strong position, you want to make sure that you are getting the most in terms of a lower interest rate and lower fees based on what type of risk you present to that lender. And so again, when we end up looking at this, it's something where if you are in a position, make sure that you negotiate to end up getting the best deal possible. The last thing that most lenders will end up looking at is the relationship. It's going to vary based on the type of lender, the length of that relationship, what is the history and past performance, and then what is the quality and timeliness of the information. Having the ability, and this goes back to that data collection and analysis, having the ability to provide high quality data to a lender gives them a tremendous amount of comfort in terms of being able to make sure that they are comfortable with the position of the farming operation and that we are on top of our finances. I think it's something that's really important to be able to show that we can end up generating some of these documents on a timely basis. One thing that I see a lot of, or I get some questions on, is loan structure. And there's a bunch of different categories that we can break this into. I already mentioned interest rate differences. One of the things that is important when we review our loans on an annual basis is if we do see the ability to save on interest, I think we need to take advantage of that, even if it is just 25 basis points. We want to make sure that we are able to lower that interest cost. We do have to be careful to make sure there's no prepayment or payout penalties, but at the same time, we want to make sure we lower that. So that can be a loan structure. What are the annual debt servicing requirements versus the amortization, right? So when we look at this, the amortization is the length of the loan. When we're looking at if you have a longer amortization period, you're paying more interest, but you have a lower monthly or annual payment. And so we need to end up making sure that our annual debt servicing or payments matches where we are anticipating our income to be. If not, we might need to look at terming out or increasing the amortization period if that is available. Payment timing is another big one. We want to make sure that payments coincide with when we end up having income. So again, if you're going to end up storing your crop until March before you sell the majority of it, you probably don't want to end up having your loan payments due in January 15th. And the reason for that is quite simple. Typically, we see operating loans that have higher interest rates than term loans. Not always, but that's usually pretty typical. So if you end up having a land loan, for example, and the payment is due on January 15th, if you don't have them, if you haven't marketed your crop and you're going all the way to March 31st, you'll typically take money out of your operating loan, make that land loan payment, and all you've done for that 3-month period is exchange a low interest rate on that payment amount for a high interest payment amount. So again, we want to make sure that we structure when we're working with our ag lenders, structure those payments at times when we know we're going to have that extra money. Or you can end up always prepaying a lot of these loans, or make sure you can prepay these loans. And that way you don't have that extra interest because of a residency time of a term debt payment in an operating loan. One of the other big ones too, particularly under these uncertain times, is that financial flexibility, right? We want to make sure that we're maintaining a good liquidity position and that we have the ability to be reactive because there is a high degree of uncertainty in the economy right now and in commodity prices. So we want to make sure that we're aware of that. Another one that I think we have to be careful with, and I'm going to use a very simple example, is making sure that we're not paying for capital items using operating credit. Because it can do a bunch of different things, but I'll use a quick example of how it can adversely affect a ratio. So we have a starting position here where we have current assets of $75,000, current liabilities of $25,000, total assets of $1 million, liabilities of $200,000. So we have a 3-to-1 current ratio, a 0.25 to 1 debt to equity ratio, both excellent based on the metrics that we had in the earlier slides. If we turn around and we buy that truck through our operating loan, what we've done is we've increased our total liabilities to $250,000. We've increased our current liabilities from 25 to 75,000. We've added that asset to total assets, and so our debt to equity ratio is still really good, but our current ratio has went from 3-to-1 to 1-to-1, which would fall in that weaker area of those metrics. And so again, when we look at that, we've adversely affected that current ratio. If we use term debt, and in this example, I put 5,000 on the operating loan, and then the remaining 45,000 would have been financed. And so again, what we've been able to do by using the term debt is to end up having a 2.5 to 1 current ratio versus that 1-to-1 ratio that's there. Now, again, there are considerations in terms of rate repayment capacity, but the reason for doing this analysis is when we end up having banks that are going to end up having some analysis of the different ratios that are out there, you will get a risk rating based on that analysis. And if we have a ratio that is adversely affecting that risk rating, it can affect the cost for you to access credit or potentially even the ability to access credit if we're not staying on top of where we're at, right? So what we're trying to end up doing is making it so that we are structured appropriately so that we can, as cheaply as possible, access the credit we need when we need it to end up doing or to end up producing and marketing our crops. So just tips for working with lenders: start that relationship early. Like I said, you don't have to get every loan or credit product from one individual lender, but you do want to have somebody that you can bounce ideas off. Create a narrative. It's a huge difference if you bought a farm and you just want to get debt free as quickly as possible versus if you want to expand from 500 acres to 5,000 acres over the next 20 years. Very different dialogue that you would have with an ag lender. Provide data and records in a timely manner. Obviously, they have your lender has requirements that they have to meet. Helping them do their job is a benefit to you as well. Make use of his or her expertise, particularly when we're doing large capital purchases. It's something where a good ag lender has probably done far more loans in the course of even a year than most farmers. will do over the course of their entire farming career. And so they've probably seen some things that can be of a big benefit. Talk to your lender if you're experiencing financial distress or unforeseen circumstances. I've said this several times, but time is always your enemy. The only thing that time does when you're in a financial stress situation is remove options. And so the quicker that you can have those conversations and look for possible solutions, the better off you will end up being in terms of being able to access different alternatives. When we're looking at the loan renewal application checklist, I'm not going to read through all of these, but I do think that it's important to be prepared, come in with those tax returns, those key financial documents, what ended up happening last year, where were yields, where were prices, what ended up happening. There's a lot of things in farming that's outside of our control. There can be some reasons what's going to happen in terms of crop insurance or other payments, as discussed earlier in this presentation. What's a list of outstanding loans, your liabilities? What are the terms and the payments? Is there the ability to end up having savings there? How much inventory did you carry over from 2024 into 2025 or the next production year? Because that's obviously going to affect where your financial position is at that year end. And then a list of any capital purchases, any projections for the upcoming year, and then any plans that you may have in terms of risk management, marketing, or succession plan. So when we look at kind of the take home message, we always need to end up making sure that we get out there and start this process early, not just for 2025, but for future years. We want to make sure that we have the credit lined up needed to, so we're not scrambling while we're trying to end up producing or marketing that crop. We need to evaluate all those existing debt and capital requirements for 2025 and all those past loans where there's the potential for savings. Know that current financial position and negotiating accordingly. It's something where we don't want to leave or pay more in terms of fees and interest than what's absolutely necessary. We're going to have a tight margin time period, likely as we move forward, based on where people are projecting commodity prices to go. So we want to make sure that we're attentive to these small savings because that can help us in terms of a margin. Make sure that we structure those loans appropriately. Poor structure can really affect profitability, but it can also affect our ability to access credit cheaply or cost effectively and build a relationship with your lender over time. It's something that I think that can be a real valuable piece of expertise that can support your farming operation. With that, I appreciate you watching the video. If you do have any questions, please reach out to me. My contact information is on the screen, and I appreciate the time.